I talk to dealers all the time. I spoke with a national car dealer kind of on a background call. He didn't want to go on the record. He said that demand in EVs is strong on the coast, but about 100 miles inland, with the exception of a few pockets, this is his word, demand is almost zero.
Tesla and top China automakers are pumping the brakes on the ongoing price war that shook the space this year. Companies like BYD and Xpeng joined the Elon Musk-run company in signing a pledge to regulate EV pricing in the country after calls for a crackdown.
So I don't think too many people care about the long-term earnings power, of Tesla.
All that and more. So let's get to it. We're doing a little bit of catch up. Every time we do Throwback Thursday, there's always a little bit of news that we miss. And with the 4th of July holiday, of course, we missed a little bit more. On the heels of Tesla's Q2 delivery numbers, Morningstar had an update. Let's go ahead and check that out first. Looks like Morningstar gave Tesla a downgrade from 3 stars to 2. For those that aren't as familiar with Morningstar's rating system, let's go ahead and take a gander, shall we? Prior to the update, Morningstar believed Tesla was at a 3-star rating, which indicates our belief that investors are likely to receive a fair risk-adjusted return, approximately the cost of equity. Now, they're at a 2-star rating, which means they believe investors are likely to receive a less than fair risk-adjusted return. Considering they haven't updated their fair value estimate at $215 per share, I guess that is to be expected. At the time of writing this note, Tesla was at a staggering $279.82 per share, with a market cap of almost $830 billion. Record deliveries keep company on track for solid growth in 2023. Seth Goldstein writes, "We maintain a $215 per share fair value estimate and narrow moat rating for Tesla following the company's second quarter deliveries." During the quarter, Tesla delivered 466,140 vehicles, a new record high, and more than 80% above the prior year quarter, which is a little less than 40% growth for the year, and we maintain our outlook. Now, there are some things that could go wrong. Tesla could lose production at any one of their factories: Fremont, Shanghai, Berlin, Austin, setbacks at Giga 1, anything could happen. Tesla is well beyond the pace of 1.8 million vehicles for the year. Let's see if Morningstar's conviction will continue in Q3 when they continue breaking records for deliveries and production. At current prices, we view Tesla as slightly overvalued, with the stock trading a little more than 20% above our fair value estimate, but in 3-star territory. Accordingly, we recommend investors wait for a pullback in shares and for the stock to trade below our fair value estimate and offer a margin of safety before considering an entry point. There are plenty of fearmongers out there saying that there is a looming recession right around the corner and that the Fed is nowhere near done with their rate hikes. But as we approach Tesla's Q2 quarterly results, we're going to find out that they're as close to financially bulletproof as any other company out there. Tesla plans to release its second quarter results on July 19th. We will be focused on the automotive segment's gross profit margin during the quarter. Tesla implemented a cut to prices to drive volume growth, similar to the prior 2 quarters. As a result of the price cuts, the automotive gross profit margin fell to a multi-year low in the first quarter. However, lower prices should be at least partially offset by lower unit production costs as a result of the continued production ramp of the Austin and Berlin factories and falling raw material costs. We forecast 2023 automotive gross profit margins will reach the low 20% range, before improving back to 29% by 2030, which was the 2021-2022 average. While the margin decline was driven by price cuts, we expect that much of the margin improvement will come from lower unit production costs. Tesla aims to reduce unit production costs by 50%, as the company outlined on its investor day in March. This should drive a margin improvement, particularly in the Model 3 and Y vehicles, partially offset by the eventual sale of lower priced vehicles, which will likely generate lower profit margins. True, I agree, Tesla will benefit from economies of scale. Plus, with their intention to reduce costs by 50%, I'm not sure if that's with the Model 3 and Model Y. It's definitely going to be a key factor in Shanghai expansion and the Nuevo Leon factory. There is no doubt in my mind the next generation vehicle will be the vehicle that costs 50% less to produce. and they're going to be spitting them out faster than they've produced anything else. It's going to be an exciting time. But there is one little thing I would push back. I don't think Tesla is aiming for any margins that are really higher than 25%. That only occurred is because Tesla's demand was blown way out of proportion. It couldn't produce nearly enough that was being ordered. As the gigafactories become more efficient, Tesla is less likely to run up against a situation where they're going to have to raise prices significantly to meter demand.
Joining us now is former Ford CEO Mark Fields. Mark, good to have you back on again. Listen, people say, why am I knocking on EVs all the time? I'm not. The technology is cool. I woke up this morning in the Upper Peninsula of Michigan. I know a lot of people in Detroit, and I talk to a lot of people in Detroit, and I'm just going to tell you, there's a lot of people in mid to upper levels of management and line workers who are worried.
Well, the moment of truth is coming at us. And the reason for that, Brian, is, you have a number of high volume products in major segments, particularly for GM, that are going to be launching in the second half of this year. And when you look at affordability and you look at even the price of electricity is up significantly from, a couple of years ago when the automakers were starting to work on these electric vehicles. So, the issue for GM right now is their sales are small because they're ramping what they call their Ultium battery pack, which goes into their Cadillac Lyriq and their Hummer, which are, listen, by design, very limited volume vehicles. But later this year, they're launching the Blazer and the Equinox. And, that's the moment of truth because they dedicated full plants to these. These are high volume plants. So they need these vehicles to sell for them to make a return on their investment.
Well, considering GM's track record, it doesn't look very good. Hopefully they've learned a lot from the Chevy Bolt. I mean, they didn't learn enough to make it profitable and then they discontinued it. So maybe this new battery platform will be enough for them to see some profits because that's what it's going to take. We're going to have to start benefiting from economies of scale and start benefiting fast. Problem is, vehicles in the interim, they don't have to be perfect. They just have to be good enough for consumers not to be frustrated. These growing pains are going to feel unique and quite new to both Ford and GM. It's going to be interesting to see how their consumers and their CEOs respond to this adversity. And trust me, there will be some adversity.
Excuse me, I've ridden in some of these cars. I rode in the electric GM Hummer. I rode in the Celestiq, which was, by the way, a beautiful car, one of the coolest looking in interiors and exteriors that I've been in. But when I also see, and I talk to dealers all the time, I spoke with a national car dealer kind of on a background call. He didn't want to go on the record. He said that demand in EVs is strong on the coast, but about 100 miles inland, with the exception of a few pockets, this is his word, demand is almost zero. Is there a chance that Detroit, one of the great American cities, I love the city, is headed down a path where they're going to make a bunch of products that people don't want?
I think we're putting the cart before the horse here. In these early innings, GM, Ford, even Tesla, they're not producing EVs for the heartland of America right now. What they need to be thinking is global. The EV market in China is just a preview of what the EV market will look like in America. And that's only if Ford and GM are competitive. If they were making 10 million electric vehicles, this might also be my concern. There's no infrastructure. These individuals don't even know they want the vehicle yet. But that will change. By the time GM ramps up to their stated goals of a couple million by 2026, that sentiment will have reversed. Unfortunately, Tesla will be well on their way to 6 million vehicles per year by then.
Detroit is ahead of the curve, right?
Okay.
In terms of bringing products to market. The demand isn't there right now. I mean, right now, Brian, as you know, folks like GM and Ford made announcements that they were using the Tesla supercharging system a couple of weeks ago. And the reason for that was the OEMs are looking at it, they're saying, hey, I got these products coming to the market. I need to sell them. I need to take away any inhibitor from a customer that says, I may not want to buy this because it's difficult to charge. So I won't say, it was panic at the disco at the automakers, but they realized these products are coming. And, it's harder for consumers to charge a vehicle than to fill up a tank of gas right now. And that's weighing heavily. And that's why you're seeing inventory of EVs today about twice the day's supply, which is how the industry measures inventory, twice the day's supply of internal combustion engines.
Well, I guess if you make EVs, they're going to pile up in inventory. I don't think Tesla's having that problem. 466,000 vehicles delivered.
Volkswagen just laid off workers in Germany because they're slowing the production of their ID3 and ID4 cars. And again, we're told this is the future, and I'm going to get a bunch of tweets, which is fine, which is there's nothing you can do about it. Just deal with it. This is the way it's going to be. California, no gas sales until 2035. And again, that's fine. Everybody should buy the car or truck that not only they want, but can afford and best suits their lifestyle. And when I think about people, landscapers, that are pulling around tractor trailers all day long for hundreds of miles just to try to make a living or live 100 miles outside of LA because they can't afford to live in Orange County, how is this going to work for them? And I just hope, and you were in the boardroom, are those conversations taking place in the boardroom that not everybody is like you or I, and I can have an EV because it's my third car?
These concerns are valid today. But if you wait until Tesla does the dirty work, you're going to be behind the power curve. You need to be setting the innovation standard. 10 years ago, these concerns were amplified by 100%. Where are you charging this thing? Why is that thing so expensive? On and on and on. Fast forward 10 years later, you now have the Model 3 priced lower than the average selling price of a brand new car here in the States. You have a supercharger network that gives rebirth to a term like manifest destiny. Coast to coast superchargers, destination chargers. But it didn't happen overnight. There won't just be a steady progression of innovation and adoption, it will be on an exponential scale. Worrying about the problems of today will only handcuff you and prevent you from seizing opportunities in the future. You don't need a lot of money to go EV. You just need to be smarter with your money.
Those conversations actually have been happening over the last couple of years because you're exactly right. When you look at early adopters of EVs, they got a lot of income, right? It's their third or fourth car. You know, if they can't charge it or they can't, get it repaired, no big deal. But now you're getting to mass adoption. And as consumers are looking at the products, it has to have the right quality, the right price, but it also has the right convenience for them. And so I think when you look at the Detroit automakers, listen, they're a little bit insulated because the money where they make the most, products they make the most market are the big trucks, the big SUVs. Those are not really tailored for EVs. But you got now a sweet spot of a lot of high volume product in key segments that they fertilized for, they spent capital on it, and they have to make these products work and these plants hum.
Tesla and top China automakers are pumping the brakes on the ongoing price war that shook the space this year. Companies like BYD and XPeng joined the Elon Musk-run company in signing a pledge to regulate EV pricing in the country after calls for a crackdown. So does this signal an official end to China's pricing wars? Michelle Krebs, Cox Automotive Executive Analyst, joins us now. So does it from your view, Michelle?
I think the jury's still out on that. It's not clear how binding this is, and it's a very competitive market. The Chinese market is the biggest EV market in the world, and everybody wants their piece of it.
Right. And so now that we kind of think about how these competitors are going to go after a consumer and trying to make sure that their EV is perhaps the most adaptable too in the changeover for some of those drivers out there from a combustion engine to an EV. How has the infrastructure messaging moved forward in a region like China versus what we've seen in other parts of the world?
Well, the Chinese government has really made the transition to EVs much more. They're pushing it a lot more than we have been. The U.S. is just getting on board with that. We've been a little behind. Europe is pushing it as well, but China by far is the lead. So there is a big push on every aspect of moving to EVs.
Michelle, let's talk about EV expectations for domestically. What's your expectation for this year?
We believe that this will be the first year that electric vehicles hit 1 million units.
I hope that's not news for anybody. The rate of EV adoption in the US is growing exponentially. I hope that nobody thought 1 million units in the US was news.
About 800,000 a year ago, and we think we'll surpass that 1 million mark, and we're on track to do so.
And then additionally, when you think about beyond new vehicles, some of the existing vehicles that perhaps will make their way into the circular part of the economy, which is really just resale or used vehicles at that point. Are we seeing any pickup among used EVs right now?
We're starting to see some of that build. We haven't been selling EVs all that long, and what was out there was mostly Teslas. But we are starting to see some inventory build for used vehicles, and that should be a good market for people who want an affordable way to get into the EV market, because new EVs are pretty expensive at the moment.
Speaking of affordability has been an issue when you're talking about new vehicle sales. The prices continue to just remain elevated. What's your expectation, your forecast for this year for new vehicle sales in total?
We're a little bit more cautious than others. We had a very robust first half, surprised us, and so we upped our forecast. We expect 15 million vehicle sales this year. That's about 1 million more than last year. But the market was running hotter than that in the first half. We just think that we need to be a little bit cautious about the second half. We know that there's going to be another interest rate increase, and possibly two. And there's already been a lot of pent-up demand unleashed. And we just wonder how much more of that is there. We've seen that on the retail level, and we've seen that on the fleet level. So we're just being a little bit more cautious.
The Fed could raise the rates 4 more times before the end of the year, and it will not diminish new car sales. From what I gather, people don't give a flying about their interest rates. Since this time last year, interest rates on vehicles and houses have damn near doubled, and that's a best case scenario. As long as the consumer is able to make that car payment, I don't think they really care if they have a 7, 9, 12% interest loan. They're going to continue to purchase as long as their bank is willing to give out that loan. Will they reach the maturation date of that loan? Odds are probably no, but it won't stop them from getting it.
We're also facing a possible strike by the UAW as they negotiate a new contract with Ford, GM, and Stellantis.
For GM, since you just mentioned them, we got their second quarter figures, and 691,978 total vehicles sold, and 15,000 of those EVs right now, about 15.6 thousand of those being EVs. At what point in this broader kind of EV war do you foresee there being a real competition from some of the legacy U.S. automakers like a Ford, like a GM, and competing with the output, the production, and the deliveries that Tesla is seeing, even though not all of those necessarily are based on new purchases, given that they're getting through a backlog in some cases?
Well, we think the pie is going to grow bigger, and that these legacy players, as well as some of the newcomers, will take a bigger share of that. We already have seen that Tesla's market share will come down. They're still dominating in the market. They're still number one in EV sales in the U.S. and luxury sales, for that matter. So they will still dominate, but they will have more competition from. We'll see others taking pieces of that pie.
Looks like I gotta say it again. Tesla is not worried about GM or Ford's electric vehicle sales. They're just not. They need them to produce more so that they can hopefully, eventually, stop making these internal combustion engines. Over the years, we're going to see their ICE sales collapse.
I just want to talk all about Tesla, the EV market. These stocks have been hot, right? Now what? Our midday panel is ready. Andrew Graham, CEO, Jackson Square Capital, and Doug Astrop, Managing Partner, Exponential Investment Partners. So when you look at these record deliveries, Tesla's second quarter deliveries topped expectations. Andrew, I'll start with you. How are we doing in the world of EV deliveries? What's your interpretation and outlook?
So I don't think too many people care about the long-term earnings power, of Tesla.
What? Did I hear that correctly?
I think the deliveries, the fact that they were strong, puts upside pressure on the stock in the near term. So I would look for that in the short term.
I see. Okay. But overall, you were pleased with the deliveries from the company, Andrew?
Yeah, absolutely. I think, again, it's a short-term move in the stock. The long-term, doesn't look quite as compelling.
I did. There's no long-term play here with Tesla. It's a nice move in the short term. Ooh, this is going to be interesting.
Okay, let's let's leave it there. And I'll be right back. Doug, your thoughts on what you're seeing from Tesla and the fundamentals there?
Yeah, fundamentally, it's a great business. They've got a great margin, 18% operating margin, 25% return on capital. And that operating margin is like 2 or 3 times what the Detroit companies earn. So from that point of view, it's a great business. They have a great balance sheet. But it does feel like you're kind of chasing a hot stock here. It's doubled year to date, and it sells for 75 times forward earnings. So it's tough to really jump in here. It's kind of priced for perfection and not much of a margin of safety to protect you.
It really, I don't know. I'm just kind of confused. Have they not modeled it out? Like, have you not done the scenarios? It almost seems like they're just using arbitrary indicators to decide whether or not Tesla stock is too high or too. I don't know. I really want to know where they're valuing Tesla and where these numbers actually come from. It's mind-boggling.
So in the meantime, dealer inventory of EVs has grown to record levels, but I will say the pace of EV sales growth fell from the first half of the year compared to last year when sales were growing. There's still a big demand for EVs, right? Andrew, when you look at this, you have Ford and GM and, people are getting on board. The EV outlook?
Yep. So it's very positive, very strong. Tesla made those deliveries at the expense of margins. So they cut prices 15% at the beginning of the year. But those deliveries show there's still good demand for their products. But honestly, it's a deteriorating fundamental case for Tesla when you're sacrificing margins for unit volume growth.
Industry leading margins, even after the miss in the first quarter. Industry leading margins. It's hilarious.
The year, earnings estimates for the stock were 34% higher, the consensus number was, and revenue numbers were 10% higher. And I don't think those are necessarily too low at this point. So again, the good point, Tesla up 130% year to date. If you look at the stock back, whatever it was, 2 weeks ago, when the Twitter news broke that Ford owners are going to have access to Tesla supercharging stations, the stock went up 6%, which is the entire market cap of Ford, by the way, which is kind of surprising.
Not if you modeled it out. This analyst in particular seems to be concerned with Tesla's overall market cap. And by concerned, I mean doesn't feel Tesla should even be at this level in the first place.
I actually think these agreements with Ford and GM might be negative for Tesla. The charging stations were a moat for Tesla. Tesla owners knew that. They had access to those charging stations. And Tesla makes very little money on it. I mean, I think Musk and some others in the company have said 30% gross margins, 10% net margins, but that's really aggressive. If you look at a gas station, for example, and I know they're not necessarily comparable, but to me, it feels like exchanging that business, like that's going to be the business going forward, is like picking up pennies in front of a steamroller. And it just, at some point, the valuation will matter. It's not today. Stock goes higher, at least all things equal, notwithstanding the market. It should be biased higher in the near term on those deliveries, but ultimately it's going to come down to valuation.
I'm really curious to know what their metrics are for the evaluations to put into their models. You guys are hung up on market cap, PE, and all of these other metrics that typically apply to an automotive company. But Tesla does more, and so their evaluation should be indicative of that. When the Q2 results come out, one of the biggest things I'm looking forward to reading is how the energy business is doing. And if you're new to this, my bear case of 364 has no reference to the energy department in it. I'm just solely going off of the automotive sales, but Tesla does so much more. That's why my base case is ridiculous and my bull case is redonkulous.
So from superchargers to gigafactories, all kinds of factories all over the place, stiff competition, but a growing demand going forward, most likely. Doug, is Tesla a buy or the other names a buy?
Well, I completely agree with Andrew on that, that, the valuation's going to matter at some point, and buying it at 75 times forward earnings is really tough. It's a hot stock. You feel like you're chasing this euphoria. And so we would wait for a better entry point. It's definitely a great company, but tough to buy at these levels. It's sort of priced for perfection. And if there's one modicum of bad news comes out, it'll get hit pretty hard from this level.
Andrew, you have a name that you like, or the group the names that seem to be the leaders to you?
Yeah, so the news today about the price cutting détente in China is sort of interesting because the Chinese automakers are ascendant. They are delivering improved quality design and tech. And I think it's a lot easier probably to buy the auto suppliers. So that would be Magna and others, Goodyear Tire. So I would focus in on those suppliers. It doesn't really matter how much you're making on the vehicle or margins. They're going to have to fill it with these parts. And so I would look to buy that. And Magna has a nice 3% dividend yield. So China is going to be expanding globally, and they're doing it in Europe now, and they have the eye on the U.S. as well. It's bad news for GM, Ford, and Tesla.
Well, I would agree that it's bad news for GM and Ford, but not Tesla. Tesla's not concerned. They need these Chinese automotive companies to improve EV demand overall. We just saw a video saying that when you go 100 miles inland, the demand is almost nil. More EVs is not a bad thing, especially if you're producing millions of them. But that does spell bad news for Ford and GM. These analysts are very measured. They're very calculated on what they believe to be fair value. But I bet these individuals didn't see Amazon being what they were today, nor Apple, nor Nvidia. Tesla is actively disrupting two industries, one being energy, one being the automotive sector. And I'm not even going to go into the robo-taxi or Optimus or Dojo. Tesla has the most exciting product roadmap of any company out there. So you can listen to these guys if you want, or you can do your homework. You can model it out yourself and then decide for yourself whether or not you think Tesla is overvalued at 75 times earnings. But I guess my risk tolerance is a little bit higher than the average bear. You see what I did there? Yeah, you see it. In conclusion, the theme of today's video is Tesla's overvalued. Get the f out of here. Throw in the concerns for EV demand and you've got an absolute shit sandwich. Don't take my word for it. If you're serious about investing in Tesla, model the company out. See what it's supposed to look like this year, what the expectations are, and whether or not Tesla meets or exceeds those expectations. That's why I do Tesla Throwback Thursday, is so that we can see what they were saying in the past and how they respond to the future. And then you can make an educated guess about how they'll perform in the future. Don't take my word for it. Definitely don't just take what these analysts say for face value. Do the work yourself. I know without a shadow of a doubt, Tesla is going to be the most valuable company in a decade's time. And two, EV demand is growing at an exponential rate. By the time we reach 2028, it won't be if I buy an EV, it'll be which one. Well, that's all I got for you today. Be easy. Hey.